All right, we're live. Fantastic. All right, welcome everyone to the live show. I think we're through that little bit of dramatic entry. My name's Thomas Atkinson. As always, I'm joined by Tyrone Abela. And Tyrone, I'm really excited to be talking about market session opens. People are really into day trading and, of course, scalping at the moment. And why not? I mean, volatility yesterday was extreme, and of course, it offers that opportunity. So, welcome everyone. How are you feeling today, Ty? Are you excited for the volatility in this current market?
I'm a little bit excited about the volatility. We've certainly seen some fireworks, no question about that. Some key levels were hit, and then inflation reared its ugly head again, and off we went. So, look, when people want to scalp and day trade, market opens an extraordinarily important part of the techniques they can use, because you can really, signify where you want to actually be. I mean, if you want to trade the London Open, you know the hours you have to be there. So I think it gives people structure, and it gives people the ability to actually focus on a certain time of day and actually try to master it. So that's what really today is about, trying to identify those opportunities when they do present, and be able to target them at certain times of the day, so you're not sitting around looking at your charts all day, because no one wants to be doing that.
No, that's exactly right, Ty. So, of course, day trading market opens. We'll be taking a look at today how to select the best levels ahead of a market open. So, really just focusing in on which market open is best for certain things, and of course, the levels you want to be looking at. Which market open provides the best trading opportunities, and 2 trading strategies that can be used around these market opens. As always, we'll have a live Q&A as well with everyone here. So, if you have questions, please feel free to ask them throughout today's session, and we'll hopefully be able to answer them pretty quickly. Now, Ty, I bring up this quote every single week at the moment, and that's because it's so important. Successful tape reading is a study of force. It requires the ability to judge which side has the greatest pulling power, and one must have the courage to go with that side. It's super important for us to think about markets this way. Can we successfully read the markets? Can we get the edge that we need? And can we also replicate that edge? That's something that you'll hear Tyrone and I talk about a lot, the ability to be able to replicate. Just before we go any further, we do have a quick disclaimer. So we'll just quickly put that in, and then we'll meet you on the other side. Okay, so Tyrone, which pairs are best to start with? We always usually use a slide similar to this as well, because realistically, these are the best pairs to start with. Depending on the session,
Definitely.
we'll talk about the ones for the different sessions, because of course, something like this highlighted S&P 500 down here, while it's great to trade it, there's certainly a market open that you may want to trade around that you'll get the higher liquidity. And which one would that be, Ty? I'm pretty sure most people don't know this one.
100%. Look, and the thing is too, I'm sure all of you have heard the adage, jack of all trades, a master of none. It is actually technically true in trading as well, where people just try to cover so much, and they don't actually become familiar with the nuances and the way a market, particularly, especially at market opens, does actually tend to move. When you familiarize yourself with particular types of patterns, and also particular types of pairs that act in a similar way most of the time, not only do you get a chance to actually work with that, but also, probably just as importantly, Tom, you get an idea of when something's not quite right. And that's sometimes the time to stay out of the market. If things aren't behaving as they normally would, or as you would expect, sometimes are the times that you want to stay the hell out. And you couldn't possibly know this if you don't become familiar and intimate with the pairs that you're trading. So although there's only a small amount on the screen there, you could make a pretty good living just trading those, couldn't you? You don't have to look at you don't have to look too far past that list right there, really.
Yeah, absolutely. There's no reason to, really, in many ways. Otherwise, you're just basketing very similar trades. I mean, realistically, if you trade the S&P 500, the trade that's here is often also in the NASDAQ, also usually in the Russell 2000. Sometimes it's in the DAX and FTSE, though these can be disconnected because of the nature of the underlying. But you just need to think about, as Tyrone said, be the master of a few. And especially with session opens, this is important. If you're in, let's say, Europe, or even in Australia, and you are going to trade the London Open, a very good time for many, many viewers out there. The Euro USD always is number one for most people. The pound US dollar is another incredibly common one around session opens. And if you're in the Asian session, the odd US dollar, the US dollar yen, and of course, if you're in the US session, things like the yen can come back as well, can't they, Ty? But you get like a little bit more of a mix then, because you've got that cross kind of period between both of them. And just to mention that, of course, which is best for you? Now, for someone that's in Australia, Ty, what would you think? Would you think the London session in terms of currency is the way to go?
For currency, London is awesome. And look, the thing about Australia is that obviously, look, if you're going to trade at 1 o'clock or 12 o'clock in the middle of the day in Victoria or in Sydney or basically anywhere on our side of the woods, you're going to have a very, very lackluster market nearly across all of the currencies, right? There's no hiding that. But for the most part, if you do work a normal job or even, London Open happens at a pretty reasonable time for people to be able to have a job and also be able to trade. So, generally, 7 p.m., 5 p.m. during daylight savings time, it's a little bit early, but it's a very, very sound time to be able to dedicate an hour or two to scalping if that's what you want to do.
Mhm.
And the London Open is a very, very important thing. What I would highly suggest is people take a snapshot of this little screen that we've got on at the moment. Understand the times. Very, very important to understand when the opens are, and most importantly, when they cross over. Okay. If you know that and you're familiar with that, you will always be ready and probably not be taken by surprise when a market opens and you're not aware of it, and all of a sudden the trade goes awry, and you think, "Wow, where did that volatility come from?" London Open, Frankfurt Open, the US Open. So very, very important. Keep this on your screen until you're very, very familiar with when the opens actually are.
So as it says down here, the Asian session has a higher tendency for ranges to hold, that is trading within a range. Now, a good strategy if you know that a session, e.g. the back of the US session, Tyrone, and also the Asian Open and the Asian session, if you know that they generally tend to be range bound, then wouldn't it be better for us to use certain oscillators, things like MACD, things like stochastic, all of these ones come to mind. And that's actually a trading strategy in itself. When we first
Most
started
definitely.
trading, we used to, I remember very clearly, the back of the US session into the Asian session was a great time to bring indicators onto your chart. And it tended to be the best time to use oscillators, wasn't it?
Yeah, definitely. And if you use the wrong oscillators in a market that's not obviously playing the game for that oscillator, it's useless. In fact, it's actually detrimental if you're using the wrong instrument. Like if you're using the wrong oscillator, say in a market that's known to actually break out trend and has volatility, and say you're using a stochastic instead of a Bollinger Band or a moving average, it's actually detrimental to your trading, and it's going to give you false signals. Whereas if you know the market is range bound, all of a host of indicators come in that can be very, very useful for that period. So really, you've got to work with the tools and the times that you're given and the times that you decide to trade. And understanding that time, just like understanding the instrument that you're trading, is extraordinarily important. I think probably underrated how important it actually is.
Yeah, I agree with that.
Mm,
It's super underrated.
mm.
In fact, let's just jump into the charts here. And I see someone in the chat messaging and saying use sessions in TradingView. Well, of course, Pepperstone does have TradingView, and you can use that, and you can use an indicator that's quite handy, such as a session indicator. And if you notice, it'll come up with little highlighted colors for all the different times. So you've got the highlighted color for blue, which is the Asian session in this case. You can change them. With the green, which is the London session, and then you've got the crossover here, which is London into the back end of the US session. So highly liquid period is usually in here, very, very highly liquid. And one of our favorites is to trade the London Open, especially for currencies. That tends to be the currency one. So if you were, let's say, a currency trader or a Forex trader, and you're also a commodities trader, they tend to have very strong plays during this open here, don't they, Ty?
Yes,
And
definitely.
these are just little, it may sound simple, but these are actually advanced techniques. A lot of people don't consider the instrument, as Tyrone was talking about, and even the indicators for these periods. So
Mm,
if we were trading the Asian session, a lot of the time we'll use oscillators and those types of indicators, back end of the US into the Asian session, the
yep.
range bound strategy. In the London strategy, we would be looking more at Forex, FTSE, DAX, and of course, commodities, gold, oil, those types of things, some metals. The metals exchanges tend to be quite liquid here. If we're then trading into the US Open, what we're looking more at then is, of course, S&P 500 US dollar pairs. And, in some cases, you can, of course, trade oil commodities as well still. But in general, the S&P 500 becomes a very, very good trade. The NASDAQ, the IWM. You love the Russell right now, don't you, Ty?
I do. I do. I just saw in the comment, is it possible to trade the US 30 identifying as she, her? Oh dear. Yes. Yeah, most definitely it is possible to trade. Funny enough, that you asked about the US 30. You know how rare it is that I actually put that on the chart these days, Tom.
Mm.
I'm just so
Used to love the
fixated
Dow
with
too.
I used to love the Dow, but really the Russell 2000, the S&P 500, and the Nas
Yep.
just give
Yep.
you so many opportunities in there, and they're just so technically sound that I'm just not so sure that the Dow actually gives you the same technicals. I don't think you need it.
It doesn't.
I think
No.
you're actually trading. You're kind of trading. It's almost basketing, but you're taking the in my mind the weaker basket. I'm a lot more comfortable with the other three at the moment.
Look, I'm always going to go S&P 500 first, but I would actually say the second is the Russell. Or I'm putting down the code for the ETF, the Russell 2000, because
Yeah.
the US 2000 is incredibly good, and there's a real reason why Tyrone and I go to these straight away. Again, it's just a little advanced tip. Can anyone in the chat, before we actually disclaim why we like this as one of these two pairs, can anyone guess why we really like the S&P 500 and the US 2000? Put it in the chat window and we'll see. I'll read a quick other one here in terms of Tom Quimby, in terms of some questions that are coming through. So we've got one coming in from Liz. It says here that use, of course, sessions on trading chart. Absolutely, sessions is excellent for the opens. And then we have a question, or not so much a question, but just more of a statement. Is taking more than 10 to 15 trades per day bad? Look, I would probably say that is sometimes possible, and a technical, really heavy scalper may do so. I found, and I think Tyrone will agree with me here, that usually less is more. And in fact, what you're really doing is you might even see opportunities on the chart, but you want to take replication strategies, 10 to 15 trades. Sometimes you could be replicating that whole day. In general, I would say that's usually over trading, and it can hurt your account because it means, remember, the trades you don't take can be some of your best ones. And I know that sounds ironic and ridiculous, but it is true.
Yeah, it seems, and if you're taking that many trades, it really comes down to how many instruments you're trading too. Like if you're doing that on one or two instruments, you must be taking very small take profits, and look, they're scalping and they're scalping. I mean, yeah, in my mind, and I think we've said it before on many webinars, 15 to 20 pips is where we're at for a scalp, as nearly as a minimum. Like we're not going for anything shorter. And yeah, if you are going for those, really, really aggressive scalps, I almost think, Tom, that we need to find another word for those trades, because I don't think that's actually scalping when you're going in for 4 or 5 pips. I think that's not really scalping in the true sense of the word.
High frequency.
It's high frequency. It is high frequency.
High frequency trading, yeah.
Yeah. So I think that, it sounds like a lot of trades. I mean, man, I don't know if I'd do that many in a week.
Yeah, sometimes you don't. It's rare. I'll answer this question so we don't leave it. S&P 500 and US 2000 are our favorites in terms of the market indices, and the main reason is because there's so many companies. 500 companies in the S&P 500, 2,000 in the Russell, and this means that there's a lot more sectors inside of them. So it's not as susceptible as to one sector or to manipulation as much in chop. If you've ever wondered why you get ripped apart, maybe trading the NASDAQ a little bit more, it's often because it will spike a zone and then retrace it, taking your stop loss. If you compare it to the S&P 500, you'll often find the Russell and the S&P 500 will not take those lows, will not take the spikes, and your stop losses will hold a lot better. And if anyone's had that feeling or had that kind of approach and seen in the markets, put it in the chat because I think it will help quite a few people. Now, there's so much to go through here today, Ty, but we want to just break down these opens. So we'll use the first strategy that we often talk about. And the first strategy is actually quite simple. Let's say we go with the euro US dollar here. Sometimes people can look at it and they'll go to the daily, and people know that daily high lows are pretty important. The high and the low of the day. And more importantly, when highs and lows are taken before a session. So sometimes a market will take a high low and then it will just instantly reverse. And it will happen quite often. And when that does occur, or it goes up to that high low and around that area and starts to reverse, it can be a good signal to go in that direction. And that is to go the opposite way, to go with the the new movement after it's gone in that direction. So if we go down here to the 1 hour to explain it, here we have the previous closure. You can see that even today, the market came down during the back of the Asian session, came back down to these lows, back down to the close of the previous day. And then just as the open happened, it hit a new low and then instantly reversed. And now it's going to the bull side. Now, the reason I want to say this is because somebody said here, it's really difficult to trade after big news. So you have to think about how big the news is. Of course, we just saw a 5% down day in the NASDAQ, a 4% or almost 4% down or something like that for the S&P 500. That's an historically large move. When that occurs, a statistical amount of the time, the market is usually bullish the next day. And that's because it needs to have a little rest, especially if it's come into a support. Now, that's partially why it's going up right now, but you've got to be very careful to trade the chop, to trade this session. This is very tough. What you're instead doing is you're saying, okay, remember we talked about range-bound markets. The market has remained within this area and this area here throughout the Asian session. It then comes back down, it hits the low, and then instantly reverses. So you could have used oscillators here. You could have used your knowledge of it taking the low in terms of coming back through the close of the previous session and then coming straight back up. And that change becomes a trading strategy around opens, doesn't it, Ty?
Yeah, that's right. Yep. And it all comes back to understanding it and knowing and expecting that to happen. I think it's really the preempting of what may happen and being prepared for it. Like we've mentioned many times before that, trading can be like a bit of a game of chess in the sense that you're waiting for the right time to strike and actually positioning yourself to take advantage of that move. And this is really, it's no exception, but understanding, the instrument that you're trading at the time that you're trading it really gives you a big advantage because you're never really caught by surprise. I mean, sometimes you're going to get an out of the blue surprise where you're like, oh, wow, I didn't see that one. But for the most part, you're anticipating what's going to happen. And if the market does what you need it to do, awesome. And if it doesn't, leave it alone. And I think that's probably the important takeaway.
Yeah, that's right. If it doesn't go through the levels that you want, then just don't do it. So some people measure up, they measure the previous kind of low point of the previous day, they measure the high and they put both of those in because the high low is super important. And once you've got those two levels, then sometimes you might remain kind of around that support or around that resistance into the open, might go a little bit higher, reverse, or in this case, you might just start structuring up and show that reversal off that level. And that's a good, higher statistical chance of finding some kind of successful trade because, of course, it's testing what you already know from the previous session was an extreme level. A lot of people usually take the break of that zone. They say, okay, I'm going to break that daily. It goes to the new high. And then, of course, they go with that direction. The main problem with that is you get a lot of this kind of thing going on. So where you get that high taken and then bang, straight back down. And that is actually better to trade to the short side here and also better to look for the trap. Sometimes trap trading is one of the best forms to recognize when the market has trapped in people that are taking a closure, a support resistance break, something like that, and then it reverses. And this all comes down to understanding certain schematics as well that you can replicate. Things like Wyckoff setups, and of course, one that we've talked about in many webinars recently. If you go check them out on Pepperstone, you'll be able to see it. So yeah, daily high-low closes and around the open is very, very important. And if that does occur, you can be pretty confident that there is some potential opportunity that you can load with your other indicators onto the charts. The other one that we want to talk about today was the back of the US session into the Asian session. And as we mentioned before, it's all about range-bound oscillators. So oftentimes, although today was not really a great case of this, you'll notice that the actual movements are very, very small during these areas in general. Look at the movement here in the Asian session compared to the beginning of the London session. Look, this is currency. Look at the movement the previous day in the Asian session, which is here, which is quite large in this one. Then you go back over, very small. Go back over, relatively small. Go back over here, relatively small. And the key is that it's usually smaller than the rest. So therefore, oscillators will be your best move. And which ones do we like for that, Ty?
Well, the oscillators that we love in range-bound markets, I mean, the number one go-to there is always going to be stochastic. It's the one that gives you the up and down movement in the smaller time frames. That really makes sense for a range-bound market. Now, there are ways that you can use MACD, RSI in those instances as well. But really, yeah, the go-to for us is really, channeling up. Well, I think what that really highlights is you look at it and you say to yourself, all right, there was that one breakout. We looked at 5 examples there of the Asian session, and only one of them really traded outside that range. Now, if you were trading, and this is my point, if you know that the Asian session is fairly quiet most of the time, and you're going to trade a range bound market, 4 of those 5 that we just showed you, and we're only talking about we didn't pick and choose. We only showed you the last 5. 4 of those 5, you're going to have a very successful day. Okay, one of them wasn't a day that you were actually even be trading, so you may have lost one. By the time you found out, but after that, you weren't touching it. You know what? It's out of the ordinary. You're not used to it. Just leave it go. The other 4, you've made probably an ample amount of trades every day to actually take advantage of that range bound market. So understanding what is not normal is just as important as understanding what is normal, so you can actually apply the right strat. Now, when you look at the stochastic oscillator that we've got here, we've got the range bound movement. You can see the overbought and oversold. You can see that they're basically lining up. I mean, when you look at the oversold, it's effectively getting movements. You got to keep them in line with obviously the range for the day, but you're definitely going to get scalps in there. There's no question about that. You have to understand that's a quiet market, and in some ways, range bound markets can be the easiest markets to trade for people who are first starting out.
Yeah, absolutely. In terms of like moving into markets of range boundness or anything like that, it is easier because you can technically scalp it, and this is where you're going for those smaller amounts of points. You can be in, you can be out. A lot of new traders, they're not prepared to hold the position over news, and that's why the Asian session can be actually underestimated by many traders out there, because even though you're only looking for small moves, it also means less susceptibility to this thing here, which if you're in the right way is great. But of course, once this news comes out, there's also a chance of being slipped. And that's very, very aggressive. I mean, you can see this news came, which was the inflation number, and it just went boom. And in a few seconds, your scalp can be wrecked.
Yeah.
And whereas this session over here, much less susceptible to this.
Yeah, exactly right. And we do know a lot of news is released around those session opens too. So you've got to be really, really mindful of that. Suni asks a question. I'll read it before we actually lose it off the screen. She's hesitant about trading the US 30. Someone told her that it's not good to trade as a female. Is that true? No. Absolutely not. Trading is an equal opportunity thing that you can do. Females have just as much chance of getting it right as men do, and the instrument has nothing to do with it. If anything, Tom, from our experience, ladies actually make sometimes better traders than men because they're actually more patient and more concise in what they're trying to do. Where sometimes as guys, we can be a little bit YOLO. We can be a little bit enthusiastic and sometimes a little bit trigger happy on the trades. Whereas, as much as I hate to admit it, females can sometimes have a lot more control and discipline. So if anything, it's an advantage. Okay. So it's definitely not a disadvantage. And no, I've never heard of a particular instrument being biased to one side or another. Absolutely not. What about you, Tom? I haven't heard that one.
No. Absolutely not. Absolutely not. So you'll notice that when you get into these blue marked areas, you have some potential, and this is actually the type of one that I'm looking for. The previous session highs and a retest in the back end of the Asian session into the London session. This is the type of thing that you really like to see. And if you get that kind of overbought stochastic around this area, a potential new high taken like it did here, that's exactly what you want, guys. That's the type of one that you're really looking for. Yeah. Now, obviously, Tyrone and I use different styles all the time. This is more just around opens, but that is the classic one. The take of the high, the instant reversal from that, obviously a whole bunch of oscillators coming out, and it happens probably looks like around the Frankfurt section. So generally when you come into a market open, we've always going with the idea of being in around, or at least coming into the market around 30 minutes before to do your pre-pair. And that means you want to get the high of the sessions before. You want to understand where the market is. If the market takes that area and this becomes like kind of like a swing failure, That's very, very important. And this is a high quality style trade. That take here and then reversal off that zone coming into the open can be a very, very solid style of
Yeah.
strategy. And of course, a take profit for this would be very clearly in the market structure that's down here.
Yeah. And it happens all the time, guys. We're not just picking and choosing the ones that work. This happens all the time. And it does make it very, very easy to actually get involved. And I think, from a standpoint of having a consistent strategy, I think this is probably one of the ones that you can actually rely on. You can almost bank on playing out, more often than not. And I think from a reliability standpoint and something that you can actually say, you know what, this is going to be me. And this is what I'm going to do. You can't go too far wrong starting in this area and look, we're just highlighting really how the stochastic really assists you in actually picking these zones like every single time. It's a magical indicator for this type of thing, the whole period. Yeah. But you try and use that in a volatile session in London, stochastic is absolutely useless.
Yeah.
Absolutely useless.
You'll get really hurt using it in those periods, but it'll work quite well in these periods. So particularly picking the instrument, again, it looks small, it looks slow, it's kind of like annoying, but to a lot of people, but actually it's a great opportunity when you really start to use it. And you can start stacking a few indicators. You can stack other things, can't you, Ty? Like MACD.
Oh, absolutely. Yeah. It's only annoying to people who are trading it wrong. I'll tell you, it's not annoying if you're actually trading it correctly.
Right. Well, that's absolutely correct. Like, I mean, if you look at say something like up in here, you can see the MACD is weakening over here, and of course we make that new low, we get that divergence, and that then ends up being a very good buy during this session. So this would have been a great buy. Not only would we have had the oversold stochastic, but we also have the divergence on the MACD. And if you want this indicator, it's MT4 MACD. Now, we actually prefer this one. It comes from the MetaTrader platform, which many of you be familiar with, as Pepperstone has that platform. And it's something that Tyrone and I have found to be one of the better MACD indicators, haven't we, Ty? We really like it, divergence reading.
We absolutely love it because we totally and utterly live and breathe the signal that it's giving us. We understand it intimately as to what it's trying to tell us. And really, the indicators that you do use on your charts, no matter what you're doing, whether you're day trading, long-term trading, scalping, whatever, it's so important to understand exactly what that indicator is trying to tell you. And the MACD on the MT4 is just the simplest version in my mind. It's so simple in that it's telling you the difference. All the histogram is showing you is the difference between the 12 and the 26 moving average and how they actually are reacting with price. And you can get that in an absolute glance. You can see they've got the divergence there that Tom has drawn with the yellow arrows. Straight away, you don't even need the moving averages on your screen because the histogram is telling you all you need to know. So as long as you understand the indicator that you're actually using, and by understanding it, I mean actually knowing how it works, not just looking for what it's doing. Understanding what it's doing and why it's doing it is the important part. It's going to really revolutionize the way you can actually use it, which is actually the most important thing. Otherwise, it's there for nothing.
Yeah, so it can be a really good one to add to the charts as well. And you can use things like RSI and others. I mean, there's a whole bunch. But Asian session, the advanced strategy today is to think about oscillators during that period and the back end of the US session. If you like that, then definitely consider it. For the London Open, it's all about understanding where the daily high lows are. That's a big thing. If levels are taken, similar to the one that we saw over here, where was it now? I think it was here. And if levels are taken like this one over here before the London Open, then it can be very, very solid to trade in the direction after it takes and shows you that. When we say here, patience, react, don't necessarily predict. What you're doing as a technical analyst is really trying to stack the edge in your favor. That's really about confluence. Like, how many reasons can we find that are separate to each other to potentially like this trade? So here we have things like maybe an overbought stochastic. Okay, that's a tick. We also have a take of the zone. That's a tick. And then a rejection of that area. We also have probably a new daily high because we can see the daily high was over here. Well, that's a tick because it then rejected that daily high. So all of these things start to build out. Are we around the session open? Yes. This, maybe the RSI is overbought, MACD divergence, who knows? So as we build the confluence of at least 3 to 4 or even 3 to 5 separate reasons to be in the trade, that strengthens our case to be a successful trader. Too many people fall into a trap of just saying, "Oh, I took the high." Great.
Yeah, exactly. Yeah.
Yeah, that's not enough. We want to always
No.
see as many reasons as possible to say, okay, this is a key point, and this is something that we believe is starting to stack it. Also,
Yeah.
ask yourself with your system, can you replicate it? Can you
Yes.
do that? Even if you only find 2 a week, can you find 2 trades like that a week and then start to build your statistics? Because too many people say, "Oh, I track all my trades. I put them all in
Mm,
Excel or I put them in
mm.
a history spreadsheet and all these things." But how many of those are the same trades? Are they
Yeah,
all just separate, or are they
exactly. Yeah,
replication?
and actually, that I think that goes to answer Suni's question there, that she's more of a day trader, but she thinks she always over trades. And yeah, how you can fix that? Actually, I think that is exactly how you can fix that. Make sure you're finding 3 to 5 reasons for every trade that you're
Mm,
placing. And if you're not, then you probably are over trading. I think that's probably because I would find it amazingly interesting if you were able to find 3 to 5 really good reasons to play 15 trades a day. I would be I'd be surprised. So I think that's a really good way to use that as a process of trying to work out if you are over trading. Make sure that you are
mhm.
actually looking for at least 3 to 5 reasons before you place a trade. And if they're not there, only take the ones that are, and see how that actually brings your number down. That's probably a really good way to monitor it.
So we got a question about pound as well, Ty, and a few other pairs, gold, etc. Can we look at them? So look, one of the styles that we really like, and we're actually releasing a course this week about it, is to understand scalping from a multi-time frame perspective. Now, session opens are great, and it's of course what we're focused in on here. But you've also got to think about, okay, but where are the key levels through all the time frames? Remember, we think as humans we're only seeing the 1 minute, 5 minute, 15 minute. And that's all you're focused on. What about the 7 minute chart? What about the 8 minute chart? You're seeing the round numbers that we like, but what about the charts in between those? What about the market structure? These things become really important when it comes to advanced strategy as well. And sometimes you can stack enough levels, again, confluence reasons, around opens. And if you find those, they can be super explosive. So something with the pound here, this just what I noticed just into the session is this. Remember, we were talking about taking the low or taking the high. In this case, the pound actually took the low coming into the London session today and instantly rejected that level. Now, this is a very healthy little scalp that you could have got into through that type of strategy. And again, it's just the key is to understand this is the low of the day, previous session, and that low gets taken early, then rejects and takes up and then pulls back. The actual area you want to enter most of the time is here. And this is the replication. It's not so much that you take it here, but when you see this happen, this becomes much, much more likely. And from there to here, or is very, very likely as well. And you ask the question about the pound, why? It's got to do with this over this zone. And this is all to do with market structure, supply, demand, and a whole bunch of things that'll be in our course. But this right there is the smarter entry.
And that's an inverse head and shoulders too, by the way. So I mean,
Well,
for
that's
people
what it turns
who are
into.
looking at it,
Yeah.
exactly right. Yeah. So
Mm.
you are getting the patterns, but it really is. It comes down to patience. I know it's probably the word that we use so much, but people don't fully appreciate what we mean by it. And it really is not trying to actually preempt or predict what it's going to do, but really wait for it to do it and then come back to the level that you want it. Let it come to you. Don't chase the market. Right. That's probably the best advice we can give you. The market will come to you, and if it doesn't, you don't want it. That's how I look at it. If it doesn't come to your level and give you what you want, let it go for another day and start something else. And I think it's so important. I think it's something that people overlook. So just be really mindful of that.
Here's some examples of just the kind of draw up that we're talking about in terms of the take. You'll notice that it goes to a new low, takes that low, comes back up, breaks past that last high, okay? And then usually it'll pull back after this, and that will be where you want to enter. Now, if you know how to find that level, if you know it's happening around a session open, it gives it extra probability, especially if it happens around session opens. Just before usually the session open. Notice that today happened around 30 minutes before the London Open session, this is the way that it generally does work. It's usually a pre kind of cursor. And that's why we say come in 30 minutes before to an hour before, do your analysis, get ready. And if it does take the level, you don't have to be FOMO. You'll find that markets will often do this. They'll often come up. You won't get the perfect level. Don't get me wrong. That's not what this is about. But they'll come up, they'll break that level, they'll then pull back. And when they go into this zone, that's when you want to pull the trigger onto it. Or in the buy case, you want to do it when it pulls back into this level here. It's really important to understand that. And this is the basis of really good trading, understanding the structure, understanding the first time frame changes of trend, and then getting involved in that scalp.
I think it's important actually that people get it out of their mind that they're trying to get the actual perfect entry and actually just focus on getting in the right direction. Because if you're trading in the right direction, the entry is actually inconsequential. It's just a thing that happens. But if you try to get the perfect entry, exactly, that's right. Yeah. So focusing on trying to get the perfect entry every time is going to leave you holding not much of a trading, how you say it, you're not really going to get a lot of trades in if you're waiting for the perfect entry every time, and you're going to get frustrated, and then you start making mistakes and actually taking trades because you think you're missing out all the time when they're not right. So not so much, the focus shouldn't be so much on the perfect entry, but at the right level. Okay. And that's why we always say, going for 1 or 2 pips at a time, if that's what your trading strategy is, then maybe a pinpoint, you have to be absolutely pinpointing. I would never recommend that. But if you're going for reasonable scalps of, 15, 20, 30, 50 pips, the entry point is nowhere near as important for being perfect. It's more about getting the direction right.
Well, this is the essence of it as well, Ty. You talk about entry point. It's also important to understand your risk versus reward. One thing that's in this course is really big is it's all built around taking 4-to-1 style trades. That is, you risk, let's say, $10, you'll make $40, or you risk $100, you'll make $400. That's the type of ratio you want. And it's about making the trades that you do take that are replicatable pay, because they're high quality, and you've got to have that consistency in you. There's so many people writing in the chat right now. I take 5 to 10 trades. I take 15 trades. I take 30 trades. I know people that I've trained over the take 100 trades in a day. It's not replication. It's clearly over trading, and it's clearly not having a defined basis. And what that means is that no one can ever hold the position to the full take profit. And that is the essence of pretty much failure, unfortunately, when you can't hold.
Well, you're playing the pokies at that point.
Yeah. You're just flipping.
Yeah. The one-armed bandits. Remember the one-armed bandits? Is everyone old?
I don't, but I wish I did.
The one-armed bandits, you used to pull the thing and
they were kind of cool though. You could at least now you just press a button, and that's pretty much what you're doing when you do 100 trades. So it's important to think about this. Wyckoff, which we talk about so often, his method, or many methods out there, were always built on the market structuring a position. So when the market finds an area, it kind of finds an equilibrium, let's say, it would structure like this and often form what many of you will think of as a channel. And that's correct. That is how it happens. Often there is a false breakout, a Max Payne style scenario in the oversold accumulation or the overbought. And this was, of course, let's call the UTAD or the UT that was mentioned by him. I like to just think of it as, it's not so much that any one of these methods is absolutely correct, but understanding the structure of markets coming into market opens is super important. Understanding the area that you're in, understanding how many time frames are also seeing that. These are all advanced strategies that go around that open period. But you would be surprised how many people do not consider just that very simple thing we mentioned before, that Asian session in the back of the US session is more the structural formation. London session and US session are more this markup or markdown. That's what they are. They're the breakout sessions or the false trap areas. And the Asian session and the back of the US session build the structure over the day. And that's so common, isn't it, Ty? But so little people talk about it.
No, 100%. And the fact that it is so important. And look, I know this is an advanced webinar, so we probably assume that a lot of you guys actually, join us a lot, so you understand what we are talking about. And it may sound a little bit simple, but believe me when I say it's one of the most powerful things you can learn. Absolutely. It's most price actions are is the key indicator that we love to talk about. Okay, so just to answer that question that's in there about Pip Hunter paid indicator, not really sure about it, haven't heard about it, but like I said earlier before, if you don't understand exactly what that indicator is telling you and understand it fully, I would highly recommend that you don't trade it, because it's important to understand what you are actually using as a guide. So always understand is my advice there. Always understand the indicator that you're using and how it works.
Yeah, if you don't understand it, how can you scale the business? I mean, you
Yeah.
can't scale something you don't understand, because you'll get scared. It's just not. It just won't be a successful concept. And what also happens if it stops working? You know, you've got nothing. You can't. We always like to learn how to fish. Yeah, Ty. I like to fish and then.
And we
catch.
teach our community to fish. We're teaching our community to fish. We're even giving them the rods.
Yeah, that's right. And the bait. We need the bait as well.
and the location.
Well, that's true. Actually, it's probably the most important thing. We need the location as well.
Put your damn rod in. Yeah.
It's actually a fish farm, so that it's really easy to catch. Anyway, the Wyckoff theory here is just a bit of an example. You can check this out, but realistically, this is not going to be every single day coming in. There are some days you're going to find things like this. There are some days that you're going to just see levels getting taken and you'll recognize it. There are different strategies, but again, each strategy, you have to have a separate method for it and treat each one separately when you're doing your stats. And no one does that again. I know, because I've seen enough people where they don't separate their strategies and say, okay, which one is actually giving me the greatest edge? And that's something that's really, really important. So we'll hand it over to some questions now, Ty. And if anyone does have questions, please feel free to put them in the chat right now, and we'll answer them as best we can. But in essence, really, open trading is relatively simple. You're looking for your strategy to activate in a replicatable way. We know that the back end of the US session, Asian session is more range bound, so we can focus on more oscillators. In the London Open and, of course, the US Open period, we probably don't want to use oscillators as much. So that's very simple. You know, at least we've got a blanket rule that we could potentially apply to these markets.
Absolutely. In fact, if those markets are actually going sideways, it's probably cause for concern because something's probably about to happen and you may not be ready for it. So
that's the real structure.
That's
people misconstrue, and this is something that's in our course as well, Ty, that a long leg doji means no volume or just pure indecision. It can be a big volume day. Don't worry about that. It just means there's a lot of contracts going in and there's an equilibrium. Some people call it bulls and bears fighting it out and indecision, but don't mistake the long leg doji necessarily as, nothing's going on or a lot's going on. We just don't know exactly which direction the thing wants to go.
It's not a nothing candle, it's an indecision candle. And the more important the location, the bigger the legs on each side, the more important that candle. It's actually one of my favorite candles, only when it's used in the right direction though, or the right place. Absolutely.
Yeah, has to be in the right location. So we saw the pound obviously take the low, which was a good example for today. So thank you for the person that messaged us that one. No, I didn't see it, but of course I wasn't trading the open session today. After usually a big session like this, you know, I like to regroup and reanalyze. But this would have been a good one if I was looking at it. I like to see how it plays today, like especially around this area will be very important. It doesn't look like we have too many other questions coming in here, Ty, but we do have some people agreeing with us about the EU, Asia, and US session. That's awesome. We do hope we've given you a couple of tips here today that have helped you to try to form a bigger basis on your trading strategies. And we're always learning. I think that's really important. We never stop learning, guys. We never stop. We do every day. We improve things and do things. But I want to leave you with this. I always feel like we think that we can take a lot of inputs. And someone said this to me, Ty, and he's a really smart guy and he's really clear thinker, super high IQ, that kind of thing. And he says, look, Tom, we've got Cocoa Puff brains. And I said, what do you mean? He said, well, we can't take too many inputs. So what you have to do is you have to simplify things. So again, that replication comes back into it. If we simplify it and we have, let's say, 10 reasons we want to be into a trade, don't just add 11, 12, 13, 14, 15, 16 reasons. What you might want to do is set a level and say, okay, if I add a new one, let's say an input, then I've got to remove an input. does this new input give me more edge than the ones I'm currently using? And that could be a good barrier so that we don't overexert ourselves to too many things. I mean, all of us read the news. I don't usually, I try to stay away from it, but that can often frazzle our brains or other people's opinions and things like that. We want to be able to focus, keep a clear mind, and hopefully not have too much bias in our trading, because the charts will actually tell us what we want to know. And that's just something I'll leave you guys with.
Most definitely. If you guys found today's interesting, like it's obviously a very interesting topic when we're talking about market opens, but the market structure and scalping is going to be a very, very big component of our very new course, which is launching on the weekend. It's one of our most exciting courses. I know Thomas is extraordinarily excited about it because
it's good.
It's one of the very rare ones that we haven't actually done this before. We haven't attempted this before, but we're actually launching it at the start, especially as a live trading session. So the sessions are actually going to be live, just like the webinars are, for the first few weeks while we actually get all of the components through compliance. So it's going to be very different, but it's actually going to be a learning experience that is probably unprecedented, I think, Tom, for a course that we've done, and probably rightly so, because it's one of those courses where it's really easy to understand when you actually see it playing out in the live markets. And I think that's a big component of what we're doing. So if you're interested in getting on board, definitely check out our website and look at the advanced scalping course, which is launching this week, because it's going to be an absolute beauty. And we cannot wait to actually really show you guys what is actually possible when you actually do and understand the markets properly.
And if you're ever interested to find out more about what we do, you can always check us out at www.fxevolution.com. And that's FX Evolution. And if you have any questions as well, feel free to ask, of course, your Pepperstone representative. There's so many great opportunities that Pepperstone offer clients. Of course, there's so many great instruments. All of the ones we've talked about today and more are available on the Pepperstone client. And you know the best thing about it all, Ty? Most of them trade 24 by 5 and a bit days a week. And I like that, because that means that we can get in and get out and not have to necessarily worry about, market session opens and closes, which is kind of a pain if you trade the old traditional style. So thanks so much. And we hope all of you have a great rest of the trading week. And of course, enjoy some of the volatility that's probably going to come into this market. Quick shout out as well. This Friday is quadruple witching. Okay. Now, it may not worry to some people, but basically it's one of the biggest options expirations of the quarter. It happens every quarter, and there's usually a lot of volatility and let's call it trickery around this period of time. So if you feel I find it, it's a bit spooky, Ty. It's witchcraft,
It's not called a witching hour for nothing.
So there's a huge amount of options expiring this Friday, and you just need to be aware of that. So thanks so much. We'll see you in 2 weeks' time. And as always, if you have a topic you'd like to see, message the guys at Pepperstone. And hopefully, if enough people want it, we'll do it next time.
Thank you very much, everybody. We look forward to seeing you soon.
And remember to give it a thumbs up if you enjoy it. Catch you guys. Bye.